This is a debrief of task 3 from the first sample assessment for credit and debt management. You can see that this question has 25 marks available, so quite a big one in the assessment. We've got quite a bit of information provided, and we have some text boxes for our written answers. This task is looking at a variety of areas covering the syllabus. Let's have a look at the information, but notice that because we have quite a lot of information, there's a risk that we may be reading this but without really absorbing it properly. So what we ought to do is have a look at the requirements first so that we know why we're reading the information, and then we can be looking out for information that could help us to answer the question. So in part A of the task, it asks us to outline whether the sales director should have any role in deciding to grant credit to RJ Properties, and there are 2 marks available for this. It also asks us to explain the usefulness of trade and bank references as part of a credit assessment decision, and there are 5 marks available for this. In part C, we're provided with some numbers and we need to do some calculations for this. Then in part D, we need to analyse all of the above information and performance indicators regarding AJ Properties credit application using the headings below. So we need to comment on the profitability, liquidity, gearing and interest cover. And finally in part E, recommend based on your analysis in part D whether RJ Properties should be accepted as a new credit customer. As part of your recommendation, also consider the trade and bank references. So part E is bringing all our various answers together to form some sort of recommendation. And this is testing higher level skills to be able to form a conclusion and make that recommendation. So now that we know what we need to do, we can start reading through the information and try to decide whether or not it's going to be helping us to answer the question, and can we use it in our answer in some way. Syncit Limited supplies kitchens to both individuals and business customers. The customers include property developers that build luxury apartments and are offered credit terms of 60 days. Now remember, you have a highlighter tool available to you in the exam by using the menu bars at the top of your screen, and we've been given this information of 60 days here, and we just need to be aware that when there's a number included in the text in the question, then it's there for a reason and we should be using it. So let's highlight that to remind us that that needs to appear in our answer somewhere. So we're further told that Syncit Limited has been approached by a potential new customer, RJ Properties. Syncit Limited requests 2 trade references and a bank reference from potential new customers. They also ask for published financial statements for the most recent 2 years to calculate and analyse performance indicators. So we know we've got to do that later on in the question. The sales director of Syncit Limited has requested a £250,000 credit limit for RJ Properties as he believes they'll be a valuable customer. He is friends with the managing director of RJ Properties and can provide assurances that the business is in a healthy position. The Credit Control Department has received the following information relating to RJ Properties. So before we look at those references, remember the first requirement was asking us to outline whether the sales director should have any role in deciding to grant credit to RJ Properties. And in the information, we're told that the sales director is a friend with the managing director of the potential customer. So we can see that there is a familiarity threat here, and the sales director may lack objectivity. So we can start putting that into our answer. So we can say the sales director is a friend of the MD of the customer. This is a familiarity threat to the sales director's objectivity. We can also say that the sales director will be incentivized to increase sales so that his performance appears to be good. So he has a self-interest to increase sales, and arranging good credit terms with his customer RJ Properties may help to do that. So we see there's also a financial objectivity threat here as well. So there are 2 marks available for this, and we've made 2 comments and in full sentences, so that should be enough to cover the various points that we need. Now, Part B asks us to explain the usefulness of trade and bank references as part of a credit assessment decision. Now, notice that the question says trade and bank references. And in AAT's marking scheme, it says that there is a maximum of 3 out of the 5 marks if you only consider trade or bank references, but not both. We are provided with 2 trade references, and let's have a look at these now. So trade reference 1 received from Bluig Limited. So we have traded with RJ Properties for several years, and they have credit terms of 45 days and a credit limit of £150,000. The company has always paid to terms. Now notice that we've got some numbers here. So we've got 45 days, which is shorter than the 60 days that we're proposing, and also a credit limit of 150,000, which is also smaller than the 250,000 where we are proposing. What about reference 2? This is from Jubilee Bathroom Suppliers plc. So we have traded with RJ Properties for several years, and they have credit terms of 30 days, again shorter than the 60 days we're proposing, and a credit limit of 200,000, again smaller than the credit limit that we are proposing. So in terms of the number of days, the existing trade references provide credit for fewer days than we're providing, which should give us some comfort. Because if they're able to pay within 30 days and pay within 45 days, then we should be comfortable that they're able to pay within a longer 60 days. For the credit limit though, for 150,000 and 200,000, so it looks like that these suppliers are less willing to give as much credit as we are proposing, so they're not taking as much risk as we are. Remember, the idea of the credit limit is that we're going to give them £250,000 worth of our products, and they may not pay us. So the risk is that we may lose £250,000 worth of money. So the 2 existing references are less willing to take such a big risk, and they're only allowing them £150,000 and £200,000 of credit. Now for this question, it's not asking us specifically to comment on these 2 trade references, although remember at the very bottom of the question, that's what Part E is asking us to do, is to decide whether or not we're going to give any credit. So in Part B, it's simply asking us in general, are trade and bank references useful? But we can use these 2 trade references to give us some ideas about how to answer this. So what could we say about this? Now in this particular case, we've got 2 good trade references, haven't we? So we can say that good trade references will give us comfort that a potential customer will pay us on time. Again, just comfort though, it's not going to be a guarantee, is it? But also, if we get any bad trade references, that's going to be really helpful, isn't it? Because if these customers had credit terms rejected by other suppliers, then it would be a good suggestion that we reject credit terms as well. We could also say that trade references will give us a good idea about how much credit we should offer. Now in this particular case, they've both offered less than we're suggesting, so potentially that suggests that our offer is a bit too high. And then a final comment that potential customers will only suggest suppliers where there is a good relationship, so we are unlikely to see any bad references. So it's going to be one-sided in terms of these references. It's not really giving us a full picture. So let's move on to the bank reference now, and in this case it's provided by Royal Midland Bank, and we get a very brief, considered good for your figures quoted. Now in this case we don't get very much information from the bank, but nevertheless we could say that the bank reference provides some idea of the potential customer's financial standing. Are they in a good financial position or not? And as we can see in this example, bank references tend to use just standard phrases and will provide very limited specific information about that potential customer. So it's going to be quite difficult for us to use this as a way to judge whether we can really trust RJ Properties. And another issue is that the bank will have limited information about the customer's behaviour. They may know that they have some cash, and they may know they perhaps don't have an overdraft or don't have many loans, but they don't necessarily know exactly how quickly their own customers will pay us. So in this case, we've said a total of 6 things to cover the 5 marks available. And there's no harm in writing a little bit more, just in case any of the other comments you've made perhaps aren't good enough to get a mark. Okay, well, let's move on now and look at the financial information. So part C is asking us to complete the table below for RJ Properties, and we need to show our answer to the nearest whole number. So the first one that's required is the gross profit margin. But we're not given gross profit. So first of all, let's remind ourselves what would be the formula for the gross profit margin. So it would be the gross profit divided by revenue. Well, we're provided with revenue, aren't we? That's given to us in the question. So we know that in the first year, we're going to be dividing by 15,225,100. And in the second year, we're going to be dividing by 10,794,300. But we don't have the gross profit numbers. Well, the way we can work out the gross profit is removing cost of sales from revenue. So if we deduct cost of sales from revenue, this will give us our gross profit, which we can then divide by revenue to work out our profit margins. So in the first case then, we have 15,225,100, from which we can take away 7,612,550. And that gives us a gross profit margin of, well, strangely, 7,612,550. So we have exactly 50% as our gross profit margin in 20x1. And then in 20x0, so we have our revenue of 10,794,300, and then we take away from that the 5,936,865, and that gives us a gross profit of 4,857,435. And then when we divide by the revenue, that gives us a gross profit margin of 45%. The next box we need to complete is the interest paid. So we're provided with the interest cover, and that's going to help us to work that out. So the interest cover is the operating profit divided by the interest. And we can see that in the first year we have a figure of 12, which tells us that we have 12 times as much profit as needed to be able to pay the interest. But what we need to do though is work out how much the interest paid is, which is the figure on the denominator. So we just need to rearrange the equation a little bit. So if we want to work out the interest, then we need to take the operating profit and then divide by the interest cover. So in 20x1, we've got an operating profit of 3,045,020, and then if we divide by the interest cover of 12, that gives us an answer of 253,751.66667. And the question tells us we should round to the nearest whole number. So we can see that where we have a 6 after the decimal point, that means we're going to round up to 2. So our answer is 253,752. And then in the second year in the column, at 20x0, so we have our operating profit of 2374746, and we want to divide by the interest cover of 10, and that's going to give us 237,474.6, and again, because it's 0.6, that's going to round up to a 5. So we have 237,475. And then the last part of the table asks us for the trade receivables. So let's remind ourselves of the formula for that. We're given the trade receivables collection period or receivable days, and that equals receivables divided by credit sales or revenue and multiplied by 365. Now we want the receivables figure, which is the numerator, so we need to rearrange the equation a little bit so that we can calculate that. So to get our receivables figure, we will want to take our receivable days, and then we want to divide that by 365 and then multiply by the revenue. So for the 20x1 year, we've got receivable days of 55. We divide by 365 and multiply by the revenue, which is given to us at the top of the table, which is the 50,225,100. And that gives us a figure for receivables of 2,294,193. In this case, we round down because it's 0.1 at the end, and that's less than 5, so we can round down. And then for the prior year, so we still have a receivable days of 55 days, which is good. And then we divide by 365, but we multiply by last year's revenue of 10,794,300. Which gives us a receivables figure of 1,626,538.35. Again, that 3 is less than 5, so when we round to the nearest whole figure, it gives us 538. So in addition to this, we're also provided with the operating profit margin, and we can see that that's become worse over time. The quick ratio has stayed the same. The inventory holding period has become worse. We're holding more inventory than last year. The trade payables payment period has become slightly better. It's fallen from 62 days to 59 days. And the gearing has become better as well, that this business is now less reliant on external debt. We're also told some additional information. So RJ Properties has been trading successfully for many years, but 3 years ago it issued a profits warning, which should be worrying for us. The company has since restructured its management team and have seen sales and profits increase, which is good news. A rights issue was made during 20x1. So in a rights issue, that's where we issue shares to our existing shareholders, and then typically at a discount to the market price to encourage the shareholders to buy them. And that will explain why gearing has improved. So remember we said that gearing has become smaller, so we're less reliant on external debt. Well, that's because in this case, we have more share capital. So it doesn't necessarily mean that borrowings have gone down, it's just that equity has gone up. So the rights issue has been done to raise additional funding for expansion plans. A small property company was acquired, which has seen a small increase in sales volumes and hence sales revenues for RJ Properties. Okay, so it's this acquisition that is causing the improvement in the revenue. It's not necessarily because RJ Properties is doing better by itself. But having said that, the gross profit margins have increased, which would suggest that the business that they bought was doing better than their existing business. So let's look at the requirements now. We need to analyse that above information and the performance indicators regarding RJ Properties credit application using these headings. So we've got 3 marks for profitability, 3 marks for liquidity, and 2 marks for gearing. And so what we want to do is really write as much as we possibly can, bearing in mind that some of what we write may not get a mark, so the more we do write, the better it's going to be. And it's going to be important that what we do is basically say what we see in terms of profitability, but also what the AAT are expecting us is to try and explain why things have changed. And we've been given information in the text to help us to do that. So if you look at the profitability, so we know that profits are revenue minus costs. So we can see that revenue has increased. We can see that costs have increased, probably because of the new management structure and because of the acquisition. And we can also see that the margins have improved. So basically, we are either cutting our costs or making higher sales or with the higher sales price. So what can we say about profitability? So remember, start off just by describing what you see. So the gross profit margin is increased by 5 percentage points, from 45 up to 50. But remember, we're going to get credit for trying to explain why we think that's happened. What is the potential cause? So one cause is that the acquired property company may have had higher selling prices than RJ Properties. So if the new company had better gross margins itself when it's combined with RJ Properties, then overall for the group, the profit margins will improve. Another possible cause is that the bigger business may have been able to negotiate bulk discounts, and that would reduce material purchase costs and reduce cost of sales. But remember, gross profit margin isn't the only profitability measure. We're also provided information about the operating profit margin, and we can see that in this case there is a 2 percentage point fall. So again, start off by describing what you see. You may get credit for expressing an opinion about this. So we are saying here there's a 2 percentage point fall in operating profit margin, and this is bad, compared with the gross profit margin where the increase was good. So being able to apply your judgment can possibly get you more marks in the exam. So what's the potential cause of this? Well, we don't have very much information on which to base this, so we just need to speculate that for some reason they seem to have increased their operating costs, their administration costs. But we do know, though, that because they've had an increase in sales, possibly they've been spending more money on advertising. So while it's sensible to spend money on advertising to increase revenue, if overall your profit margins are falling, then it would suggest that the spend on advertising hasn't been successful. Now remember that gross profit margins went up by 5% and operating profit margins down by 2%. So in real terms, it's gone down by 7%, which is really not good. Anyway, it's time to move on now. With our 3 marks available, we've said enough to earn those 3 marks, so we need to move on and earn the marks under liquidity. So for liquidity, we can talk about the trade receivable days, which hasn't changed. We can talk about the quick ratio, which also hasn't changed. However, for inventory, that's become worse, or then trade payable days has become better. So 3 marks available for these. We don't need to consider all of them, but again, we might want to do more than just 3 to be safe, if you have time in the assessment. So we could say that receivable days have stayed at 55, which suggests reasonable credit control, although 55 days does seem high. Lots of people would sort of target 30 days for payment terms. Although, as we know in this particular case, they offer 60-day terms, so 55 would actually be quite good compared with the number that we have in our credit terms. Let's consider inventory days now. So inventory days have increased by 7, which is not good, because holding more inventory ties up cash, so that's not good for our liquidity. But why has this happened? It could be that more inventory may have been bought to achieve the discounts and improvements in gross profit margins, which we talked about just now. Remember, we're looking at a separate answer box here, but this is all to do with the same business and it's all interconnected. So we said earlier that they may have tried to get some bulk discounts to improve their profit margins, and having done that, they just have a lot of inventory sitting around. For payable days, it fell from 62 to 59. And we plan to offer them 60 days, don't we? So that's good. On average, they're paying within the 60 days, but that is on average though. But we should be cautious because last year they were paying in 62 days, which is more than our credit terms. So that's a little bit worrying. And then finally, we know that their quick ratio has not changed, and at a ratio of 1 to 1, this gives us some comfort about their liquidity, that they have enough receivables and cash to be able to meet their short-term liabilities. And then we need to look at gearing and interest cover. So we can see that gearing has fallen from 38 to 32%, suggesting that they are less reliant on external debt. And we know why that is, don't we? It's just because the rights issue has increased equity. Now, is this a good or a bad thing? Well, it's hard to tell, really, because debt is a relatively cheap way of funding your business. Shareholders require a higher return, typically, than banks do. So reducing our amount of debt potentially means that our cost of capital is increasing. But nevertheless, having lots of debt is worrying. So yeah, it could go either way in terms of whether this is a good or a bad thing. So we could say that while having less debt is a good thing, debt is normally relatively cheaper finance compared with equity. Now, what about the interest cover as well? Let's just remind ourselves what the interest cover was. So we can see we've got interest cover 12 times and 10 times. So that's good, isn't it? The increase in our profits means that we are better able to pay our interest. So that's good. So we can see that interest cover has increased from 10 times to 12 times. So the increased profits allow them to pay their interest more easily. And this is a good thing. And then finally for part D, we need to make our recommendation. And there are 4 marks available here. And remember, we can talk about the trade and bank references that we saw above. So what could we say in our conclusion then? While the company is growing, partly organically and partly through acquisition, which is a good thing, isn't it, that they're growing, it is concerning that the operating profit margins have fallen, and that is worrying. As far as liquidity is concerned, it's pretty stable, isn't it? Again, we know that inventory days has gone up, receivables days is the same, payable days is slight improvement, so it's pretty stable, isn't there? But yeah, it's good that they are paying their suppliers a little bit more quickly. We also know that trade references are positive, although again we need to note that they aren't willing to lend RJ Properties as much as we're planning to lend. So you know that we were offering 250,000 credit terms, aren't we? Whereas one of the trade references was only willing to lend 150 and the other 200,000. Now we should also note as well that they said that they paid over 45 days, didn't they? But their payable days is 62, or it's now 59. So according to their financial statements, they are not meeting the trade terms of these 2 suppliers. Here we've got 45 days and 30 days. So remember that the payable days is an average of 59 days. So if they are paying within 30 days for Jubilee bathroom supplies, that's good, but it means that they must be paying other suppliers even more slowly. So that is something for us to be worried about. So overall, we need to provide some sort of recommendation, and you know, there's good and bad points, aren't there? So in the AAT suggested solution, there is no final recommendation. So it would suggest that perhaps you can go either way, but it is important you do need to make a decision and either say you should lend or shouldn't lend to them, because that's what the question is asking you to do. So while the AAT suggested solution sits on the fence, yeah, you should make a decision.